You know, that iconic blue box, the Centurion logo? American Express is, without a doubt, one of the most recognizable brands on the entire planet. But behind that familiar card is a really unique business model that one analyst at Morningstar believes has built a powerful, powerful fortress. So today, we're going to deconstruct that fortress brick by brick, using their professional analysis. Let's get into the blueprints. Okay, so you see the card everywhere, right? At checkout, in ads. But have you ever really stopped to think about what makes it so different from, say, a Visa or a MasterCard? Because the answer to that question, well, it's the key to understanding the entire company.
And here it is, the secret sauce. Unlike Visa or MasterCard, which run what are called open-loop systems, basically connecting thousands of different banks, American Express runs a closed-loop network. Think about it. They issue the card, they operate the payment network, and they have a direct relationship with the merchant. Amex controls the entire game, which means they get to capture a much bigger piece of the pie from every single transaction.
In this model just completely flips the typical credit card business on its head. I mean, for most card companies, the real money comes from net interest income. That's the interest you pay on your balance. But for Amex, that's just a small piece of the puzzle, only about a quarter of their revenue. The huge chunk, around 75%, comes from merchant fees and those hefty annual fees we pay. They're not a lending company first. They are a payment company first.
So, this whole unique setup is what lets American Express build what analysts love to call a wide moat. And yeah, you can literally picture it like a giant fortress with a deep, defensive trench all around it, keeping the competition out.
So what exactly is an economic moat? Well, in simple terms, it's a company's durable competitive advantage. It's that special something that lets them rake in higher profits for a really, really long time. It's the wall that separates a good company from a truly great one that can just shrug off rivals for decades.
And the analyst here isn't just saying Amex has a moat. No, they're classifying it as wide. That is their top-tier rating, okay? It's reserved for companies they believe can keep that edge for 20 years or more. So the big question is, how on earth did they build it?
It all comes down to this incredibly powerful self-feeding loop called the network effect. It works like this. First, Amex goes out and attracts people who spend a lot of money. Then, with all these big spenders on board, merchants are like, okay, we need to be a part of that. That entices them to join the network. Once the merchants are in, Amex can negotiate all these exclusive perks and partnerships, which, you guessed it, attracts even more high-spending customers. It's a flywheel, and once it gets going, it's almost impossible for anyone else to catch up.
And when I say high spending, I'm not kidding. The analyst report points out that in 2024, the average Amex cardholder is spending over $24,000 a year on their card. Just think about that. That's way, way more than your typical Visa or MasterCard user.
Right, so here's the kicker. That massive spending power is Amex's ultimate bargaining chip. It lets them go to airlines, hotels, you name it, and create these killer partnerships. We're talking about exclusive perks like airport lounge access or suite hotel upgrades, stuff you can't just get with regular reward points. And every new perk just makes that fortress wall a little bit thicker.
And man, for a good while now, that fortress has been absolutely thriving. So let's dig into the bull case, all the optimistic arguments for why Amex has basically been living through a golden age.
A huge piece of this story has been this massive explosion in what's normally their smaller income stream, that net interest income. Get this, from 2021 to 2024, it grew at a compound annual rate of 26.1%. That's just a monster tailwind for the company's growth.
So how they pull that off? Well, the report points to a really smart strategic pivot. They've repositioned their cards to be these premium lifestyle products. It's not just about travel anymore. And that has been a huge success in attracting a younger, affluent crowd, which has just fueled a crazy amount of new signups.
Okay, so let's wrap up the bull case. First, you've got the closed-loop network that lets them squeeze more profit out of every single transaction. Second, they've successfully fired up their lending business as a powerful new growth engine. And third, their big move to attract a younger audience has been a total home run for bringing in new, high-value customers.
But, you know, no fortress is impenetrable. So now we've got to flip the coin and look at the bear case, the reason some analysts are starting to see clouds on the horizon, and maybe a few cracks in that big wall. And this quote from the analyst report really says it all. Remember that incredible 26% growth in interest income we just talked about? Well, the analyst thinks the party's pretty much over. They believe the big strategic moves that drove it have mostly played out, and they're expecting a major slowdown from here.
And when you see the numbers, it's pretty stark. They're forecasting that growth to drop from that 26.1% average all the way down to just 8.5% for 2025. That high-octane engine is clearly starting to sputter.
And that's not the only weak spot. The commercial card business, which is a big deal, about a third of Amex's total volume, is showing some real signs of economic pressure. Spending growth there has slowed to a crawl, down in the very low single digits.
So the bear case really boils down to a few key things. Amex just doesn't have the same broad scope as the big banks. It's still playing catch-up with competitors on international acceptance. And maybe most critically, its whole business model is centered on spending, especially discretionary spending, which makes it pretty vulnerable if the economy really starts to weaken.
All right, so you've got the bulls and the bears. You've got this mighty fortress, but you've also got these gathering clouds. So what's the final verdict from the analyst looking down from on high?
Well, this table lays it out pretty clearly. You can see American Express has that awesome wide moat rating, same as Visa. But look over at that valuation column. It tells a very different story. While Visa and Capital One are seen as fairly valued, the analyst's conclusion is that American Express is currently overvalued.
And here's the bottom line, the final number. The analyst calculates the company's real, or fair value, at $289 per share. But with the stock trading well above that, it gets a price-to-fair value ratio of 1.23. What that means in the analyst view is that the market is just a little too optimistic and isn't paying enough attention to those potential storm clouds.
Which brings us to this one final, really critical question. For decades, that premium American Express brand has been its greatest defense, its fortress. But in a shaky economy, does that premium focus make it a safe haven, or does its reliance on high-end spending actually make it a more vulnerable target? That's the big question investors have to grapple with right now.